All right. Welcome, everyone. Good to be here. I'm live from my home in sunny St. Boniface in my basement, in the guest bedroom in the basement. Kids are playing piano upstairs, so it's just me, your host from the Tatro Show, Rob Tatro from robtatro.com, portfolio manager, Canaccord Genuity Wealth Management, Tatro Wealth Advisory Group. Today we're going live, guys. Thanks for tuning in. I appreciate it. Let's get the questions going. If you don't have specific questions, I'm going to start chatting. I'm going to start filling you guys in on a 2020 recap. I'm going to chat a bit about 2021, what we expect in the future. Got a couple of our internal research. Tony Dwyer, Martin Roberge, Javed Mirza, I can share and chat about with you today when we go through stuff here. 2020, what a crazy year. Oh, before I do that, take a sec to subscribe, like, share, tell your neighbors, send a pigeon. What else do people do to like and subscribe and share and do all that fun stuff? YouTube is the red button. I know that. Facebook, like and share, and Instagram. Thank you for tuning in. Twitter, LinkedIn, all that fun stuff, guys. Share, like, all that. Hey, thanks. Appreciate, guys. I value you guys here, being here. Speaking of value, this is it's the shirt I'm wearing today. A bit of value investing. We're going to talk about value investing versus growth investing today. So it's been a year where the opposite trade happened, right? 2020, the opposite happened. Anything growth dominated, completely dominated, and anything that was value ended up lagging. All the kind of value companies that are trading at discount multiples relative to historic norms. So, bank and industrials and mining and all of those manufacturing kind of mid caps that weren't kind of growth plays, they lagged dramatically. And this 2020 was the year where growth, if you had growth, you crushed it. There's a fund, Power American Growth. It's what's his name? Noah Blackstein. I think he's had 3 consecutive years. He's max growth. He's just growth. I think he's had 3 consecutive years of like 50%, if I'm not mistaken. By all means, please start sending me your questions or comments if you have any. This is meant to be interactive, not kind of different format than the Tatro Show. The Tatro Show, I talk. It's a soliloquy. I usually have a guest on. Maybe it's more like not like Macbeth soliloquy, but wherefore art thou Romeo, or whatever the heck they say in Macbeth. I was lucky enough to only have to have one Macbeth, one Shakespeare in my whole high school. It was Macbeth. It was good. But this is your chance here to ask questions. There is no guest today. It's just me. I am going to start doing a 2020 review. So let's go back to what happened at the beginning of the year. So we started the year, obviously, at December 31st, 2019, the S&P 500 was at 3230. It was up 28.8% for the year. It had its best performance since 2013, and the index rallied hard. I don't know if you guys remember this, but we finished 11 of the last 12 weeks, or pretty much the whole third quarter, up every year. So we saw a huge bounce off the March lows. Huge monetary stimulus, economic resilience, optimism about vaccine. The big theme of 2020 was definitely, are we going to have a W? Are we going to have a V recovery? That's what I feel like we talked about the most during the whole year. Are we going to have a V or a W or an L or a Nike swoosh, or what is the recovery going to look like? Well, we ended up getting a fairly aggressive V, beating, like just zooming right past pre-COVID highs. So we started off month of January, February. Those were really good months in the markets. We then have COVID. COVID hit. The last week of February ended up being fairly negative. February 23rd was the pre-COVID high, or February 21st, I think. And then March 23rd was the COVID low. March 23rd was the COVID low. For those of you that don't remember, I remember that day very vividly and very clearly. Why? Because it was the first day of the first time the Tatro Show went live. I didn't know what I was doing. I had all these different devices, Instagram, laptops, phones, and iPads. And Mox, my producer, wasn't allowed to come into the office. Neither was Diggs. I was flying solo at the office by myself because we had shut everything down. And Mox was like, let's do this. Let's get you live. People are asking a million questions. I was getting a ton of emails. So we went live March 23rd. After market close, I went live, if I'm not mistaken, at 2:30 p.m. in the last half hour of market close. I remember I was looking over at my TV that I had in the office, and I was like, markets are rallying here in the last kind of half hour of the day. These stories for me, my dad always tells a story of October 87, right? When the market fell 22% in one day. I remember March 9th, 2009, the bottom, the actual day of the bottom. I remember it. And this March 23rd is a day that I think I'm going to remember. And it happened to be the first time I was doing a live show. And I said that day, for those who don't recall, I said, this is a generational opportunity for you to be buying stocks at a historically low discount. I said, if you have money, if you got cash put aside, put half in the market today. You're not going to regret it. Do it. Put half in the market, and you could leg in the rest, but go and buy some big quality names. So that was March 23rd. That was the bottom. After that, we had a ton of fiscal stimulus, optimism about vaccine, optimism about the election, and just a crazy rally that I don't think many investment experts or many individuals thought we'd see. If we look at the actual sectors that did well, the sectors that performed well, tech was definitely by far the best. Mega cap names and semis. Consumer discretionary, that was boosted by Amazon. So Amazon had a really, really good year. If you've followed me, I love Amazon. It's been one of my top picks here for 6-7 years. Materials beat the tape. Chemicals, paper packaging among the better areas as well. Biotech and med tech, they cushioned healthcare a bit, but pharma was a little mixed. Industrials finished the year slightly higher overall. Airlines, huge drag. Casinos, huge drag. Hotels, huge drag. Cruise companies, huge drag. And finally, consumer staples were a little bit weak. So that was the story as a whole. If we look at treasury yields or interest rates, treasury yield dropped significantly during COVID. And the Fed, they cut short-term rates to zero interest rates. Zero. We saw it right here in North America. Thought we'd never see it. We saw it, and they eventually started grinding up. The dollar dropped. The US dollar dropped against most major crosses. The Canadian dollar appreciated throughout the year. The Canadian dollar had what I would say a remarkably strong year, rallied here towards the end of the year, closed right around 78.5 cents. We also had gold up 24.4%. Gold was a big story on the year. It broke through 2,000 for the first time over the summer. Oil was among the hardest hit commodities. Do you guys recall the story that happened over the summer with oil? It was mental. Do you guys recall minus $30 oil? If you don't remember this, I did an episode on this. It was I don't remember the day. It was in April. I'm pretty sure it was in April. You had contracts that were maturing for delivery, and people had investors had nowhere to deliver that oil. Therefore, if you had a barrel of oil, you had to pay someone to take it off your hands at the rate of minus $30 for one US barrel, minus $30. Maybe it was 25. I don't know, whatever. It was minus at least in the 20s. Crazy. We've never seen anything like that. You've never seen negative oil prices. It's never happened. And how can that happen? How is that possible? Well, if all the semis are full, all the trains are full, and all the tankers are full, and nobody can actually accept physical delivery of a barrel, you got to pay someone for them to accept to take your barrel of oil. And it happened. It happened in April. It was crazy. We went through the oil kind of started to recovery. The biggest market story of the year, I think, aside from yields and COVID, obviously, is the dominance of the mega cap FANG names. So Facebook, Amazon, Apple, Netflix, Google, throw in Microsoft in there, Netflix. I forget which ones I mentioned there, but those were huge. Some mega cap vaccine names also had huge years. FANG, Apple was up 80, Google's up 30, Microsoft up 40, Amazon up 76. That was a huge year. Moderna, Novavax, these are the vaccine names. They had a huge year as well. Fairly dominating year. I'm going to get in here with some questions here. A lot of questions coming in, and thank you for that. Let's start with this one right here. Is the market accurately valued at the moment? It seems that the market is disconnected with what the underlying economy is actually experiencing. Yeah, value investing is the name of the game on that point. So I think what Yannick is asking, and thank you for the question, Yannick. We're seeing an economy. The job numbers just came out in December. Negative job growth, increased unemployment. We now have something like 6% unemployment in Canada. Job losses in the month of December, 160,000 job losses in Canada, 160,000 job losses in the US. For those of you that are Manitobans, 4,000 full-time job losses in Manitoba. That sucks. So yes, you have an economy that's going the wrong way. COVID is closing. Restaurants are suffering. Gyms are suffering. Retail is suffering. Service-based retail is almost impossible right now. And all of those are jobs, hairstylists and personal trainers and, you name it, servers, and they're all kind of out of jobs. And we have this market that just got the blinders on. The market's going full steam ahead. So the question is it disconnected? There clearly is. But remember, Yannick, when we're talking about the market sees into the future. The market is pricing in the likelihood of future events happening. The market is really anticipating full vaccine implementation, and rather quickly. The market is also anticipating continued strong corporate profits, especially in the mega cap. The market is anticipating huge liquidity by the US Fed and Canadian Fed and European Fed equivalents. So that means liquidity means printing money, buying bonds, and effectively spreading money as far out as you can to consumers, me, you, whoever. In the US, they're doing it by way of $2,000 check. Boom, mailed out, you get it, you cash it, you got $2,000, go spend that money. In Canada, they're not only doing that, they've done stimulus, they've reduced interest rates, there's bond buyback programs, there's direct stimulus to the individuals, there's direct stimulus to the companies, there's tax waivers for certain companies, there's rental waivers, there's employment insurance that's been added on. So all that is effectively liquidity. Call it what you want, but it's the money going easy on us, either retail investors, individuals, businesses, organizations, so that we can survive and pay more jobs. So liquidity is the biggest point of this. Yannick, our analyst, Tony Dwyer, issued a comment, and basically he's always said, don't fight the Fed. I have a shirt. I'm going to wear it at some point for you guys. It says, don't fight the Fed. Don't fight the Fed. If the Fed is willing to spend money, this is the argument that Tony Dwyer is making. The market will continue to go high. Now, I do have a bit of a macro kind of forward-looking view for you. I'll get to it in a sec, but I do want to get to the questions here. How can governments around the globe keep increasing their debt levels at this pace? Are we simply heading for a massive credit crisis? Debt levels seem unsustainable. No. Well, debt levels at pre-COVID and 5 years ago interest rates would kill our economy. If the government was paying 3% on their debt, or 4 or 5, it would effectively kill the government. There's no way they could afford to pay the cost of capital, the cost of borrowing. Think of you and I. Let's say you have a mortgage, Yannick, and I don't know if you do, but let's say you have a mortgage and you're locked in for 2 years and money's extremely tight. Sorry, you're locked in for 5 years at 2% and money's extremely tight. And 5 years from now, you have to renew and interest rates have tripled. Well, your mortgage payments just went up dramatically, right? And if cash flow was extremely tight, you're no longer able to make those payments, right? So maybe you default. It happened in 81. My dad always tells a story of people getting wiped out with real estate in 81 because leverage, right? They were highly leveraged. So you had a bunch of different properties. You own 5, 6, 7, 10, 12 properties. You got 5% down on all these properties and you're just collecting the rent and you're paying the interest payments and the mortgage. All of a sudden mortgage rates go through the roof. You actually can't make your mortgage payment and you're not going to start tripling the rent on your tenants. So what happens? You let go of the first property, then you let go of the second, and leverage is a double-edged sword, and it doesn't go well. Now, do I think that's going to happen to the government? Not short term. And I don't think medium term either, for a couple of reasons. One is they cannot afford to let this debt problem, I'll call it a problem. We're printing money and we're creating debt at a rate never seen before since the Second World War. And they also control the monetary policy, right? They also control what their own debt is basically being charged at, right? So they're going to keep interest rates low for a long time. Now, eventually, you want to have, in theory, in a strong economy, you want to have a little bit higher interest rate than 0.25%. But short term, medium term, I don't think I don't think you can expect to see any move in the interest rates positively. And I also don't think that you're going to see that. Therefore, I don't think the balance sheets are going to suffer as a result. Now, Yannick, there's no doubt that long term, if we look 20 years in the future, if there's this continued debt and we're trying to grow our economy, our balance sheet, and the interest rates are trying to go up, but we can't, we're limiting that, one of two things is going to happen. Either we're not going to permit that growth because of the debt, or you're going to have to pay down the debt at some point before that. So it's kind of like the 20-year-old who's got a ton of credit card debt and is just saying, don't worry about it. I'm just going to keep paying minimum payments and I'll be fine. I'll be fine. I'll be fine. Well, you can't just make minimum payments forever on a credit card. Eventually, you got to make some payments. You got to make more payments, or you need to reduce that interest rate. So I do think it's a concern, Yannick. Obviously, all the economists are talking about this. Everyone's talking about the potential kind of impending doom that our kids are going to have to deal with. I have 4 kids. They're playing the piano upstairs. But are they going to have to face this? They will at some point. And I expect to see some sort of monetary policy that factors it in. And I think we've learned so much in the last 100 years with respect to monetary policy and fiscal policy that I don't expect the governments and the feds to blow it. Maybe I'm too optimistic. I don't know. But I do think short-term, medium-term, I don't think there's a concern. Let's keep going here. I got another question here. Thoughts on Bitcoin? Oh, Ralph, I knew I would get this question. Who here hasn't talked to their neighbor, their cousin, their grandson in the last 6 months and told them how many millions of dollars they're making with crypto and Bitcoin? So I'm just going to address your question as crypto as a whole, not just Bitcoin, but Ether, PP coins, the Bitcoin Lite, Bitcoin Cash, all of the crypto market as a whole. What is it? I have it here. It was over $1 trillion. Where are we at now with the market cap for crypto? $924 billion market cap for crypto. It was at $1 trillion yesterday or 2 days ago. So here's the thing with crypto. Those of you that followed my show know that I've kind of changed my tune on crypto. I used to be extremely bearish back 4 years ago. I did in fact call the last crypto bubble. I went on BNN when it was at like 18,000 and I called the bubble. I said, this is going to end badly. Short term, this is going to blow up. And, we're years away from crypto being, I actually went through a scenario that my brother had helped me build about how much of the float of currency, how much adoption we needed as a society and at what pace in order for crypto the valuations to make any sense. And I did this on BNN and it was kind of neat. So I did that and I believed that it was a bubble. That was in 2016 or 2017, whatever it was. Now, about 6 months ago, I had due to my interest kind of raising in crypto, I had one of the crypto guys come on my show. He told a story about how he lost, I forget, Mox, what was it, Diggs? I think it was like $3 million, $2 million kind of live on his show. During his show, he lost $2 million. He was sharing his screen and someone hacked him live during his show. It was the coolest thing. The video is still on YouTube. So he told that story and he was talking to me about crypto. Obviously, there's risk with crypto. We know that if people are losing $2 million from their wallet live on show. But I did say that crypto as an asset class is a ton more defensible to me now, kind of like gold is. And, I thought he said, 1% of your portfolio net worth in crypto is not the worst thing for individuals that want to have a max growth risk profile and that fully understand the volatility and truly get that they're not buying an investment. It's an asset class that does not pay a dividend. If my dad were here right now, he'd say, I'll buy crypto when it pays a dividend. But him and I disagree a little bit on this because I do think it can make sense for some high risk portfolios, for individuals that are young, want a ton of growth, don't really care. They're not going to look at it. It can make sense because if you ever get some sort of crazy adoption, well, I mean, the ceiling's not 40 grand on Bitcoin, right? If you get full-fledged adoption. And to me, there are still serious issues. Like you need to figure out, the whole money laundering aspect, the whole, securitization, the whole wallets being hacked, all that stuff is a serious issue that, they got to deal with. But, there's still adoption, right? There's crazy adoption. And we know it's a finite currency. For people to use it as a store of value, people always say that crypto is a store of value, right? Store of value. But, the US dollar doesn't move 40% in a week. I think Bitcoin doubled in this year, and I believe it's up tenfold in the last kind of 8 months or 10 months or something. So that's typically not what we see for a store of value, and that's kind of never happened to gold. But so be careful. It's not a speculative trade that I would suggest you do. But hey, I'm not going to stop you. If you want to gamble and you want to do, by all means. If you're asking me a balanced portion of a portfolio, what makes sense? I'd say 1 to 2% for an extremely aggressive client. That's defensible. Go to the next question here. Bitcoin. Jeffrey Dean. I love this guy. Went to school with Jeff Dean. Really smart guy. Thanks for tuning in, Jeff. With US, we went to kindergarten to grade 12. Same school, one building school in LeBrokery, Manitoba. With U.S. employment numbers still below pre-COVID numbers and U.S. economy far higher, are we in a bit of a bubble? So the bubble concept is a topic that's come up a few times today, and it's going to keep coming up. But the short answer, yes, Jeff, I have some concerns that there are certain asset classes that are starting to look bubbly. Now, some of that, someone's going to ask me about Tesla. I'm sure someone's going to ask me about electric cars. Someone's going to ask me about clean energy. Someone's going to ask me about, and I think some of those asset classes are potentially approaching bubble territory. So, it's not all companies that are the same. It's not all companies that are definitely doing that. But like you look at, think of an extremely large company. I'm trying not to mention individual stocks here, but think of an extremely large electric company. Let's just, and it's had its valuation go up 10 times or 20 times in the last year and a bit. And now it's the 5th most valuable company on the market, 20 times more valuable than Toyota. They sell 1/20th of the cars of Toyota. The market, I'm just getting into Tesla here. I'm sorry, I'm not talking about Tesla, but any kind of electric vehicle company that could be, I'm not talking about Tesla, but let's say I was. So you have a company that's delivering, let's say 500,000 cars last year, and you have a competitor that's delivering 20,000 times that many cars, and they're trading at 20 times less or 40 times less in some cases, which means that they're getting 1,000 times more market cap for every single vehicle they deliver. Now, I know what some of you are going to say. I know there are some big electric car infrastructure bugs that are going to say some of these companies, Rob, do more than just deliver cars. They create the infrastructure. There's revenue there. So I do get that, but kind of let's leave that aside just real quickly if we can. Remember when cannabis, do you guys remember in 2017, I also called this bubble. I went on BNN and I called this bubble because I said in Canada, we can only smoke so much cannabis, right? The guy at the Seaport Motor Hotel in Churchill, Manitoba can only smoke so much cannabis and he can only drink so many beers. We know that there's roughly 6 to 8 billion of market cap, of market size for cannabis in the country, in Canada. And yet when the cannabis rush came out, the bubble came out, and, Aurora was trading at $30 and Canopy was trading at, I forget how high it went, but really high. And Tilray went to like $200 or $300. Regardless, I said, okay, well, the market caps, we know there's a finite number of joints and gummies that we as Canadians can consume. So what does that look like? Okay, it's 6 billion. What's the profit margin expected to be in 3 years on that? Okay, it's 15%. What's a reasonable multiple that we're expected to get on $1 of profit in that cannabis sector? I said, let's compare it to liquor. Let's compare it to booze. Similar industries, let's compare it to booze. And I said the total market cap should be 8 to 12 billion total max. Well, at that time, the market cap for all of those companies in Canada was 50 billion. And I said, there's a bubble here. So it eventually fell back down to 4 or 5 billion. And on my Tatro show this summer, I said, cannabis starting to look attractive, right? Because now you're well below. Some of those names are going to get cleaned up. Some of them are going to get crushed, and you end up getting. Sorry, I was just reading the comments. You end up getting a bubble. That's why a bubble. So Jeff, I think was your question. Jeff Dean, do we have a bubble coming? There are certain industries, Jeff, where there's absolutely a bubble coming. If you don't have the perspective for future profit or future cash flow, and you can only grow the market share that much, you could argue that, Google and Amazon and some of the larger companies, some of the mega cap, they can grow their market share. Who knows? I imagine the mega cap tech companies will have much higher areas of revenue that we can currently predict in 5 years. And I said this 5 years ago. I said, in 5 years from now, these mega cap companies are going to be getting revenue that we never even thought of, right? Now, is that the case with some of these potentially bubbly sectors like electric cars, or, are we gonna? I think the current space is about 100 million cars per year in the planet. That's roughly the size of the market, 100 million cars. So I know we're going to grow that. I know eventually there's going to be a lot more cars in China and in India and in Pakistan and Thailand and Brazil, and so I know we're growing our the pace that we're buying cars. But how many cars would these large electric car companies have to sell to justify their valuation? Well, the math is pretty much all of them. They'd have to get pretty much 100% of the market share. So anyways, I'm not saying it's a bubble because they might be able to generate other streams of revenue. I'm not saying it's a bubble. And the other thing is, you can't measure euphoria. So I'm not telling you to buy or sell that. First of all, I don't even know your personal situation, so never take advice from me on this. But I will say that if you're buying those companies, you're either expecting them to figure out other sources of revenue, dramatically increase their market share by like 10-fold or 20-fold, or they get a much higher valuation than any other company. And should they? I'd argue probably not. That doesn't mean the stock will not continue to rally for a while, but you do not want to be left holding the bag, right? If you go to a party and there's a fire that breaks out, you don't want to be the last guy to leave the party, right? So that's my words of wisdom for those. If you bought some of those companies, you've now made a ton of money. I would advise you, talk to your advisor, give us a call, speakToRob.com, and take a look at maybe it makes sense for you to start taking some profits. All right, next question. Hopefully I answered your okay. Thoughts on clean energy. Okay, so this is a question I thought I would get. So renewables. This is the renewable play. This is the Biden play. This is Biden getting in, winning the election, and kind of announcing that they're going to build it better. They're going to build it back better. They're going to have cleaner energy. There's going to be, less dependence on oil and gas. There's going to be more dependence on anything that's renewable. The problem with this is, remember that the market prices everything in. If you are thinking today that you know more than the market, and I know that renewables will do a lot better, remember that the market is pricing in what was happening with Biden. The market knows that Biden has passed these incentives, etc. So some of those companies are trading at astronomical valuations, 30 times sales, 40 times sales, 20 times sales, times sales, not times profit, right? Not times earnings. Reminds me a little bit of 2000, 2001. You remember some of these companies, Cisco and some of these tech companies were trading at 20, 30, 40 times sales, 20, 30, 40 times sales. And nobody wanted to miss the party. Everyone got in. I'm not trying to tell you that this is exactly what we're seeing here. Renewables energy, I think, has a bit of a runway here. But just be aware that could also be a bit bubbly. Whenever you see stuff that's trading at multiples of sales, that is not like either a pre-IPO kind of extreme tech or extreme fintech or extreme, you want to have hockey stick growth curve. I mean, something like this, in order to justify those valuations, you have to be careful, because 20 times sales, right? Assuming you're eventually able to generate 15% margin and you get an 8 to 10 multiple on that, well, you're trading 20 times what you could be trading at a future date. So you do need a ton of growth to justify that valuation. And that may happen with some of these companies, but just be aware. That's an area that could be bubbly. So I'm reading some more questions here. By all means, guys, keep sending the questions, keep sending them in. Okay, Bitcoin numbers, inflation. Okay. Question about inflation here. Our call on inflation is that for the first time ever, we had a government that's printing money that said we're trying to get inflation up. You guys know how inflation works. Inflation is more dollars chasing fewer goods, right? So if you have more dollars chasing fewer goods, if there's 5 of us in a room right here, and there's one chocolate bar, and we each have $10, well, someone's probably going to get the chocolate bar for $10, right? But if we have a monopoly money and we can just print more money and more money, that chocolate bar is going to go to 20, 30, 40, 50, $80. It's irrelevant, right? So with inflation, just remember that the more money you print, the more likely you are of having inflation problems down the line, because you add surplus money to the float, to the capital, you keep printing money. So this is the problem in some emerging countries where some governments, dictatorial governments, decided to just print money, and eventually you get hyperinflation, and it just doesn't work. Now, we've never had that problem ever. Well, I shouldn't say ever. We've had high periods of inflation, but we've never had 10,000% inflation or anything hyperinflation. So I would say that the government went out and said, both the US Fed and the Canadian, they're trying to hype up inflation. Now, part of that has to do with the fact that anything that's cloud-based or tech or computing or technology, tech and technology, both of those, what you're seeing is a reduction in cost. Think of a TV that you bought 5 years ago. That TV, if you were to buy it today, probably you can't even buy it today because it was a plasma and it was a 10,000 pounds. But that TV is probably a third of the price today, right? So TVs, they get way cheaper in technology and laptops and iPads and iPhones and cloud computing and space for data, and that whole kind of sector, which is propelling our growth, is becoming cheaper and cheaper. So you're getting kind of a reverse impact on inflation there, because what's more expensive? Well, food, right? Groceries, food, cars, oil, gasoline, whatever it may be. So traditional basket of goods continues to have inflation, but anything that's spurring the growth is not having inflation. So the fact that the government is so not concerned about it, the US Fed, I should say, and the Canadian Bank of Canada, that they're saying we're going to try to increase inflation. Like, they got a target of 1 to 2% inflation. They want to get to 2. The last reading for inflation was 1.4%. I don't think we're having an inflation problem for a long time. I'll have gray hair and I will not be hosting. I already have gray hair, but I'll be hosting this somewhere else. I'll be doing this, I don't know, on a different platform, on a different server, it'll be a totally different world by the time we're talking about inflation being problematic, in my view. That's a macro call, but just thought I'd tell you. So thank you for the question, Gerard. By the way, Vishal, I wasn't trying to scare you with my thoughts on clean energy. I do think if you have the right clean energy company, and I do think you have great management, and I do think if the valuations are not crazy, there's a lot of good companies that make sense to get into. Okay, more questions here. There's a question here from Nick. Best performing ETF in the US in 2020? Yes, the solar ETF. There's been some. So the solar ETF has done unbelievable. The renewables and solar, kind of a similar trade. They've done unbelievable based on Biden kind of moving the needle there and suggesting that this was happening. Some other ETFs that have done well is some Canadian disruptors as well. There's I've talked about it before, the gaming ETF, the e-gaming ETF. I've had the CEO of Evolve ETFs on here. If you're a client of mine, you likely own that in your portfolio. It's done really well. Cybersecurity, cars, innovators, leaders, all of that are ETFs that have done well. You're right. So I don't know if your question is, Nick, that are you kind of hinting to me that the trade is over, that, 233% is too much, too fast? A wise man once told me, one of my first branch managers ever, when I got into the business, used to tell me, too much, too fast is never good for anything, right? Like too much, too fast. You can't just make 10 times. You can't make a 10 bagger and just expect to make another 10 bagger after that, right? So too much, too fast. You got to be incredibly careful. So this is 233% return for an ETF. So we're talking about a diversified ETF that's got, I don't know that one exactly, but it's probably got 40 companies or something in it, I would imagine, maybe even more. What are some of those trades that you guys made in 2020 that you either regret or that you're extremely proud of and you want to brag with me here? Either, you bought some fintech, maybe you bought very good food company, an IPO that Canaccord did. Maybe you participated in some of the e-gaming and, the Score, one of those companies. Maybe you participate in the junior mining sector, which, by the way, is on fire. It's on fire, the junior mining sector in Canada. Expect this to be the biggest year for flow-through investments probably in 6-7 years. I don't remember the last time we had a cycle like this. So part of that is gold. Gold has done really well, and other minerals and mining have done well as well. But part of that is the appetite for risk. I mean, flow-throughs are riskier investments. I did have a question about, I wrote some notes here. I did have a question I got about emerging. So I've talked about that before, emerging markets. I'll just talk about it again. If you have no exposure to emerging markets in your portfolio, you should consider to have some global, some emerging. The reason we believe that is we believe there are roughly kind of 10-year cycles with respect to outperformance. We think emerging is going to outperform Canada. That being said, when I get back to this, right? When I get back to value investing, you get to the point where it's going to happen at some point here where the banks, the infrastructure, the oil and gas is going to do well. Okay, Sean's asking me about Yvan Bourgeois is bragging about a stock that he did, Penn National Gaming. Good for you, Yvan. And then Sean has asked me about the outlook for 2021. Okay, so let's get into the outlook for 2021. So thank you for tuning in, Yvan and Sean and everyone who's asking questions. By the way, keep the questions coming. So, Sean, our outlook for 2021 is this. Our call for end of year S&P 500 is roughly 10% gain in the year. Canada a little bit less. So roughly 10% gain. We do anticipate a bit of a run up until inauguration. And then our call on the technical side, this is a technical call. So technical means following the charts. Okay. So this is less, less macro, what's happening globally in the economy, but it does also make sense on a macro level, right? If you think about it, people want to be part of this fund. They want to be part of the process. And then when Biden gets, inaugurated, it's kind of like, okay, now what, right? And the now what trade is we're calling for a bit of an intermediate correction in the next month or two, something along the lines of 10 to 15%. This is what I would call a healthy correction. It's definitely not something that's going to, ruin anyone's portfolios or ruin anyone's life. I know it's not fun to get 10, 15% corrections. We do think that's coming kind of for healthy reasons. Valuations are starting to get a little bit stretched. And then we are optimistic about the rest of the year after that correction. So roughly 8 to 12% gain on the S&P, a little bit, maybe a little less on the TSX. We want to, for us, we've never been solely value or solely growth or solely US or solely Canada. This is a time I think you have to be diversified. You can't get away from the momentum trade, which is, all the tech and the health and the growth and fintech. You can't get away from that. And yet you should own, in my mind, companies that are trading at a discount to historical valuations, especially large cap, extremely stable companies that are trading at significant discounts to historical valuations. I think you should have some of those in your portfolio if you don't already. So our call for the year, Sean, to finish up is a bit of a rally here until kind of inauguration, then a period where we potentially see a bit of a correction. And by the way, I'm making these predictions on my channel like I did last year on BNN and like I do all the time. I lay it out for you. I talk to you guys about what we feel is happening. Don't take this as advice. I don't know what your situation is. I don't know what you own or what your risk tolerance is. But I mean, we're talking generally about the market, and this is in conjunction with our analysts, Tony Dwyer, Martin Roberge, and Javed Mirza from Canaccord Genuity. By the way, Canaccord Genuity stock, anyone following that one lately? Whew, it is on fire. We are crushing it. Last thing I'll say about predictions, just a couple more things. One is we believe we're in kind of year 3 of a 4-year kind of cyclical market. And at the end of year 4, which would be the second half of 2022, towards 24 months from now, we could be in a position to see a slightly larger correction, 15 to 20%, something like that. And then we also think we are in the midst of a 15 to 20 year long-term secular bull market. Extremely low cost of capital, tons of money in the flow, tons of liquidity. Companies that should trade at multiples that they've never traded because there is no other option. If you're retired right now and you have $1 million and you want to retire off your portfolio, what do? Do you go to the credit union and say, lock me up for 5 years at 1% or 0.75%, and I'm going to make, $10,000 of income? No, you're probably not doing that, right? So you have no choice. You have to own equities. You got to own dividend payers. You got to own real estate. You got to own infrastructure. You got to own, even if you're extremely conservative, you're kind of running out of options, which is why I think the valuations are going to continue to stay above historical norms for the foreseeable 10, 15 years. So we believe kind of year, I don't know, this is a really shot in the dark call here. So don't take this, but maybe year 6 or 7 of a 15 to 18 year secular bull cycle. Bull meaning optimistic, going up. I do have a really neat shirt. I'll wear it another time. It says bull. I don't know what else, but it's just a bull. Okay. And not bull like BS, bull as in the bull and the bear, right? At Wall Street, you've seen the bear. The bear is a negative sign. People that say they're bearish, they expect something to fall. And people that say they're bullish, they expect things to go up. Here's Daryl here saying that he just sold his crypto today and cashed out large. Good for you, Daryl. Yannick here telling us about CNQ up 23. Oh, we bought CNQ at $11 on March 23rd. Wow, the day of the bottom. Good for you. And then a question here from Ryan with respect to fintech, specifically providing AI for loan servicing. I'm a big believer in this, Ryan. I think anything that's disruptive, anything that makes here's the thing about AI. I mean, there's AI and then there's, I'm having a memory blank. Jeff, what's the word I'm looking for when machine learning? You have AI and you have machine learning. So AI is basically the artificial intelligence. It's making decisions based on your programming. But machine learning is when the actual devices, the data, the machines, whatever you have, actually start to make their own decisions based on the data that they have. So machine learning is an extremely, extremely useful tool when it comes to loan servicing. I sat through a presentation the other day for a private company. It was, these guys do like insurance for farmland, basically the likelihood of the farmland, having droughts or whatever it may be. Well, this fintech could do it a lot better than you and I could if we sat down and reviewed so I don't know exactly which company you're talking about, Ryan, but largely I'm bullish on the entire sector. Just be careful of valuation. So if you want to get exposure to the sector, consider some ETFs. I mean, it's almost impossible to miss right now in fintech. Like anything that you bought in the last year, you're a hero. You're smart. You're the greatest investor ever because everything is double, tripled, quadrupled. These 20-cent stocks are all $1 stocks. So just, again, I'm telling you, Ryan, if you're following these companies closely, hopefully you know what the what the margins are, what the plan is. I mean, I don't know all these companies, but you want to make sure that you know the companies, because otherwise, if you're just buying a sector, well, then, buy the ETF and de-risk, but you're not going to do as well as if you try to buy the best fintech companies. I think anything that's disrupting, and we've seen probably a whole bunch of disruptors, anything that's disrupting is likely to continue to do well. Just make sure that there's a play at some point for profits. I talk with a lot of my colleagues about what are some of the biggest risks that I see in 2021. For me, one of the risks that I see, and I'll tell it to you straight, and you guys might think I sound like I'm 1,000 years old, but I'm going to tell it to you straight. I believe there are a whole bunch of investors, individuals, retails, I'll call it the Robinhood generation, that is going to get hurt. They are going to get hurt at some point here, not because they have bad intentions, not because I just have a lot of concern for how that party ends at some point. And it will end. I saw the story. What was it? You guys all saw the story. Elon Musk tweets to start using what was the name of the app? Someone remind me what Elon Musk tweeted there. To use an app, like one of these encryption apps. Please start, like 2 words he used. And the Robinhood generation went out and bought another publicly traded company that had nothing to do with it, ran up the stock 10 times. And then he's like, no, I wasn't referring to that company. I was talking about, this app. So you have that. You have the case where, people are buying stuff where they just assume you can't lose. It's been too easy. Signal. Thank you, Vishal. Yeah, Signal. So Elon says, use Signal. I think he was talking about his car, right? Use your Signal light. No, it's a joke. It's a joke. It's a bad joke, but I'm getting old, so I'm allowed to make those jokes. Thank you, Marilyn. Yeah, it was Signal. So you use your Signal light, you get old, people go and they buy the stock, and next thing you know, stock's up 800%, but it wasn't Signal. It was a totally other stock. I just think you're going to get into a situation where it's been so easy for so long. We've now had a good year or two of straight up growth with fintech, straight to the moon. And you've had, companies like Royal Bank and I shouldn't name companies, but Canadian banks or Canadian financials or Canadian real estate or Canadian infrastructure that hasn't moved. And I talk to these guys and gals, and they tell me, what do you know, Rob? What do you know? I've made 400% trading this penny stock, right? So that's awesome. I would just strongly advise you to do it in a diversified manner and just to control your risk if that's what you are doing. Question about Suncor here. Yannick, he's rolling with the questions here. Focus on green energy. How do you expect stocks like Suncor to perform in the next 3 to 5 years? Bought some Suncor at $15 on March 18th. Good call, Yannick. So I'm not going to specifically mention Suncor, but oil was Canadian traditional oil and gas was harmed, had a really rough patch, really rough year in 2020. We're now starting to see it bounce back. If consumption, if life gets somewhat back to normal, we start flying and there's going to be an increase in consumption. I'm almost sure of it. When that happens, inventories should go down. I believe that the OPEC, the cartel of producing petroleum exporting countries, is going to figure out how to reduce production. And I think you will get a time where oil prices are likely to go up. And I do believe that that is phenomenally good news for Canadian traditional oil and gas producers. Now, I am not making a comment here before anyone murders me or chastises me about, it not being green energy. I'm not referencing that. I'm simply talking about whether or not Canadian oil and gas has the prospects for increased prices in the future. Remember that when everyone forgets about a sector, when everyone writes it off, when nobody's buying a stock, that's when you finally start to see it move up. When the biggest oil bulls are calling for the end of the oil cycle, that's when, you watch BNN the last 6 months and everyone was saying it's over. Oil is done. Oil and gas is done. And I don't really want to comment here on this episode about how I feel about us using oil and gas. It's not what I want to comment about. I'm simply commenting on the fact that as consumption will start to go up, I believe the emerging markets are going to start consuming more traditional oil and gas. We're a long ways away from NIO and Tesla replacing 100% of the vehicles on the planet with oil and gas. And I do think planes and, plants and coal powered plants and there's a long way to go for those to kind of turn around. So I do think there's an opportunity once everyone's out of a sector for some smart buyers to pick some up. Question here from The Real Dig Show. Will we see a little psychedelics bump in Canada in 2021? He watched my BNN clip, I would imagine. I spoke on BNN right on, I believe it was December 31st, about this exact thing. To be clear, let me preface this by saying psychedelics is a extremely speculative investment. You're betting on shrooms, all right? You're betting on shrooms. And for those of you that don't know what shrooms are, they're like these things that you put in your mouth and you get a crazy buzz and it's super fun. But more importantly, they treat PTSD. They treat PTSD, anxiety, social disorders, etc. So there's a whole bunch of patents that are happening right now based on the research that I've done and based on the research that my firm has done, Canaccord Genuity. There looks to be some really good technology around PTSD treatment, anxiety treatment. I believe there's an ETF coming on the market this month. For the first time ever, there's going to be a psychedelic ETF. And I do believe that this has the makings to be similar in some ways to cannabis, what cannabis kind of 5 years ago. Now, obviously, it's way different in that recreationally, I don't think you're going to go to a party in Transcona and people are going to pull out, I don't even know what it would look like, prepackaged psychedelic gummies, maybe, I don't know, or brownies, I don't know, but I don't think that's going to happen. But I think the PTSD and the medicinal avenue there is significant. And I think there's an opportunity. Now that's extremely speculative, and do not take this, again, I don't know what you own. You need to be able to withstand that volatility. These could go to zero. This is highly speculative. But again, a lot of stuff is highly speculative. Everything we talked about here today is highly speculative. So be very careful no matter what you're buying these days in your portfolio. And if you're not sure what to buy, by all means, go to speaktorob.com, www.speaktorob.com. Come see us. Come schedule a call with us. We'd love to chat with you about your portfolio. I should mention again, I'm terrible at this, and I could sense my producer Mox giving me a hard time in his head because he's like, you got to plug the subscribe and the like and all that. And heart, he's telling me heart. Yeah, you got to like our page and our channel and our feed and our video and whatever. So please do that. If you're watching right now, pick a sec to subscribe. It's super easy. I want to see tomorrow 50 subscribers. So I need you guys to subscribe. Do that for me. Thank you. I appreciate it. Now, I forget what I was talking about. Psychedelics, extremely risky, extremely speculative. Be careful. Doesn't work for anyone. It doesn't work for everyone, but it can be a play that might make sense. It's funny how I used to do this, and people would always ask me about traditional sectors like financials and life insurance companies and telcos. And now the questions that are coming up are all like fintech and cloud and AI and psychedelics. And it's really, really interesting, but it's also a bit of a sign that we may be approaching the end of that run. And it's been a crazy run. If you have a portion of your portfolio in that, it's been a crazy, crazy run. I'm just kind of scrolling through some questions here, guys. I think I chatted about the 2021 outlook. We're expecting 8 to 10%. We're expecting Canada to do a little bit worse than that. We think global will outperform that. Our call on the currency. Somebody asked me about the currency here. I'm trying to find it. Regardless, I'm just going to answer what I think. I've said this before, but I'm going to say it again. We believe at Canaccord that the parity for the Canadian dollar cannot exist at 79 cents, or there cannot be competition with our dollar at 79 cents. Meaning, given that we're in a fiscal deficit, given that we're in a significant trade deficit, given that the appetite for Canadian consumption of our goods is a lot lower than it has been in the past, we are ripe, in our view, for a Canadian dollar correction. So that would mean something kind of in the range of short term, I don't know, 75 to 76, but longer term, we see it even going further down than that. Great move now. If you haven't never done this, you can take your Canadian securities, your stocks, your Canadian stocks that you've owned forever in an RSP account. If there's no tax consequences, you can sell them, convert the cash to US dollars, and then you're getting a phenomenal conversion rate on that trade. And then you can buy potentially US securities, or you can buy global securities through an ADR, or ETFs on the US exchange, whatever it may be. Again, I don't know your personal situation, but if depending on your asset allocation and your target weights for stocks, it could make a lot of sense to consider that, given that we anticipate the Canadian dollar to go lower. Now, who knows? We could also be wrong on that call. We've been wrong many times before, and we're not perfect, but that's based on our research and our data. That's what it's showing. What else here, guys? I'm approaching the end of my time here. There's a lot of questions here, but I think I'm going to take a little breakaroo here. I'm going to thank you all for tuning in. I'm going to thank you for watching. This was fun. Maybe next time we can delve into what would we like to delve into. If you have any ideas, send them my way. I'd love to hear what you'd like me to talk about on one of our shows. I should also mention I got a very special announcement coming for those of you that watch my stuff. An alternative asset class that you've never thought of, a mini series that I will be producing with my team on an asset class that you've never heard of, you've never thought of: hockey cards. Hockey cards. It's coming. It's coming. Stay tuned for that announcement. It's going to be called Chasing Gretzky. Chasing Gretzky. So that's coming. Stay tuned for that. Really, really excited because it is an alternative asset class. Art on the wall is an asset class. Yu-Gi-Oh cards is an asset class. Crypto is an asset class. Gold is an asset class. Hockey cards and collectibles are an asset class. We'll be chatting about that. Take a sec to like, subscribe, send us your comments. Thank you so much for tuning in, guys. I appreciate, I like you guys. I'm thankful that you take the time to tune in. I always enjoy the questions that you guys send my way. Sorry if you don't like the answers. If you think they're not specific enough, feel free. If you got a specific question on a stock, send it my way. I'll be happy to take a look at it and give you an answer. All right, so I will put an end to that. Rob Tatro from robtatro.com, portfolio manager here at the Tatro Wealth Advisor Group and at Canaccord Genuity Wealth Management. Thank you so much for tuning in, guys. I will see you real soon. Have a great night. A good night or a great night? Have a great night.